Hey everybody, this is Jose here. We are about to start around 30 seconds, more or less. Therefore, this is a sound test. Please go ahead and type a quick hello message on the chat box. If you hear my voice, that will give me confirmation that you hear me and everything is good and we are ready to start. So please type something nice in the chat box as a hello to our group here in the YouTube channel. Very good, nice to see you, Marcus and Frank. Very nice. Okay, so we are about to start here. That's it. We just reached the top of the hour, so let me go ahead and maximize the introduction slide and get the session properly introduced so we can get started, okay? Lisa, how are you? Geneva, Eric, nice to see you all, my friends. Very nice. Okay, everybody, welcome to the session. Today is September 15, 2019. My name is Jose Blasco. I will be your guide, and today I am guiding you in a world which is the world of sharpening our skills. Okay, so we're getting together for sharpening purposes today, and more specifically today we're going to talk about options. Okay. So I'll be a little more specific in a minute. First, let me read the disclaimer, as I always do. The following videos, clips, demonstrations are for educational and instructional purposes only. Tradewithufos provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products. Good, perfect. So the session has been introduced. Let me close the PowerPoint slide. We don't need it any longer. We got TradeStation here. And also, as I normally do during the sharpening sessions, I also have a blank page with a Word editor. So we can now go ahead and begin inputting data and build a lesson all together. And today's lesson, today's session, it's all about options, and more specifically buying options. Probably just to talk a little bit about context so we are all focused, okay? Probably you all know that in the world of options you got two options, which is either buy options, which we call debit strategy, because you pay, so money comes out of your pocket, if you wish, and therefore there is a debit. Right, so this is known as debit strategy. This is when you buy options, and then you have credit strategies, which is when you sell options. Options traders, normally we end up combining options, creating what we call spreads, and therefore in the world of spreads, you always buy some options and sell some options all together at the same time. But when you look at the net payment made or the net premium received, if it's a payment in the sense that money came out of your pocket, then we call it a debit. If it's a collection of premium because money came in your pocket, which normally is done via selling options, as I said, then we call that a credit. Okay, so those are significant different approaches to using options. Okay, and we have been looking at options in the past. In our YouTube channel, there are multiple videos that talk about options. Actually, I believe, if I'm not mistaken, there are 7 videos, 2 hours each. That's like 14 hours. Okay, many of you have watched them. It's quite intense in one hand, but in the other hand, what I would like to do now that in this group we all know what options are. Okay, and if not, make sure you don't miss those 7 videos, right? So what I want to do is to kind of go back to some of those lessons that we covered already, that we run already, and more specifically approach each strategy in a way that is independent from others, so we can get deeper into more details when it comes to understanding the strategy and therefore how to apply it and how to use those options. Okay, and today I would like to begin with buying options. Okay, but when I say buying options, okay, of course, buying a call or buying a put is probably a little too basic for this group, isn't it? So when it comes to buying options, really what I'm talking about is debit strategies. Okay, debit strategies in the world of options. Okay, so this will also apply to spreads. Okay, or any other combination of options. Okay, we'll talk about all sorts of strategies as we go. Okay, so like for example, a debit strategy could be just to buy a call. Okay, so that buying a call or buying a put. Okay, that would be a debit strategy. To buy the call, you have to pay. To buy the put, you have to pay. So that's a strategy. The classical spread that we use many times in the sessions are the vertical spreads. Okay, the vertical debit spreads. Okay, which normally is the bull call spread. Okay, but we also often use the bear put spread. So we have the bull call and the bear put spread. Those are the verticals, but there are more. Okay, in the world of options, there are more. So we can deal with, instead of verticals, we can deal with what we call horizontal spreads, okay, also known as time spreads. No, Marcus, this is not option sharpening number 7. This, if any, would be number 8, okay? But this is going to be not a generic conversation about options. I will be specifically focusing on debit strategies, okay? So if you want to call it number 8, it's fine. So we would have the vertical, we would have the horizontal, we would also have the diagonal debit spreads. Sorry for that. So we have the call and the put time spreads or diagonal spreads. With the diagonal, we also have the call or the put diagonal spreads. So there are many different types of combinations, but also other combinations such as strangles, okay, or straddles. Okay, those are also debit strategies where you buy options. Okay, other combinations such as a call or put butterflies. Okay, those also are debit strategies where we are buying options. Okay, I mean there are many more. There are many more, but I'll stop here. So the idea here is that we are buying options. Okay, we are buying options. And here's the first thought that needs to be clear in everyone's mind, because that first thought will dictate many of the rules that we use when trading options for debit. Okay, the first thought is that 99.99% of the cases, when you buy options, you need the stock to move to profit from the options trade. In other words, and when I say 99.99%, to be honest, I don't know exactly what's the number, but the majority of the times, okay, you need the stock to move to profit. When doing debits, even though they are special cases, for example, I'll write here double diagonals, just to pick a special case, okay, which this is a very complex option strategy. Not only is complex, it's actually difficult to make money with, but it does exist. Okay, and with a double diagonal, even though you pay for it and therefore it's a debit, okay, actually for the most advanced options traders in the room, the double diagonals are positive theta, so they pay you time decay even though it's a debit, okay, and they are very, very loaded on Vega, meaning that if the stock was not to move, but there was a very, very intense change of expectation of what may happen in the future, and next thing you know, the price of the options were to go up, not because the stock is moving, but because, for example, earnings is approaching, just to pick one possible scenario. Well, now those double diagonals will make a profit for you, even though the stock didn't really move. Okay, but again, that's a pretty rare case, and this is a strategy which I just said it a minute ago. It's not too easy to make money with double diagonals. Actually, most of them will end up as disappointing, okay? But they do exist, okay? So that's why I said 99.9% of the cases, for you to profit buying options, you need the stock to move, and the stock has to move in your direction. And that's how you profit. Therefore, debit strategies, in the vast majority of the cases, are directional plays. You need a move, and the move needs to happen in your direction. And because it's a directional play, okay, you will need to define the target. Okay, when are you going to take profits in this trade? Because of course, options have expiration dates. I mean, even if you were to trade stocks that never expire, as an investor, you should still set targets, isn't it? You don't want to hold a stock for the rest of your life just because you like the company. That would be, I mean, millions of people do that, by the way, but those are not the professional traders. Okay, the professional traders, we always define the right price at which to enter, and the right price at which to exit. Therefore, we need to define targets, and the targets implies the day when the trade concludes and you're out, right? So with options, you have expiration dates. So if you were not to set a target, there is a moment in time where the option will expire as well, right? So well, because of those two reasons, we're gonna define targets, okay? And often those targets will define okay, the expiration date to be used for the trade, as we have done many times together in the trading sessions, where we have been calculating the TTT. Okay, anyone would be able to type on the on the chat box what is TTT? Okay, what is the TTT, guys? I mean, I know you know. So the target would really be important to be defined, because it would set the TTT, right? So I'm just waiting here for you guys to type what is TTT, okay? Just to make sure that you guys are with me and you are listening. And if you don't know, it's fine. I'm gonna explain it, but it would make me very happy if you guys type it. Time to target. Thank you so much, Lisa. Wonderful. Yes, it's a time to target, isn't it? Because in the end, think about it. You know, let's say you talk to someone who doesn't know what options are. Okay, and let's say you don't know what options are. Let's say you are watching this session recorded, for instance, and let's say that you have never traded options before and you have heard about options, but you don't know what they are. So here's an easy way, or maybe a very interesting way on how to think about what options are. And why is that definition of target so important? So options, basically, one way you may want to think about them is you paying for time. That's what it is. You expect a stock to move, okay? And you have two choices. Buy the stock, and if you're right, you profit. Or buy yourself time, right? Buy yourself time. And if the move happens, you can still purchase the stock at the price of today, but you only buy the stock at the price of today only if the move has happened, okay? And therefore what you're doing is kind of like buying yourself time, okay? That's what you're doing. So you're paying for time. And therefore the amount of time that you expect that stock will take from where it is right now until it reaches the target, you know, that's the time to target, the TTT, that often defines where's the expiration date. Okay, so again, today what I want to talk about is first some of the key things that are key when it comes to buying options, no matter the strategy that you're going to use. One of them, I just said it, is the expiration date to be used. Okay, but there are a few more things as well that we need to identify. We need to discuss, okay? And then also I want to get a little deeper into the difference between some of those spreads, you know, vertical, horizontals, diagonals, because, you know, they all have different ways on how to behave based on the options Greeks. And since we had lessons before on options Greeks, so today I'll be able to go just a little deeper into those different strategies so you understand your choices, okay? Because right now, basically the only strategy that I've been using in the sessions have been vertical spreads or buy call, buy put. That's it. But there is more stuff that we can do. And I don't, by the way, I don't plan to make this too complicated, because in trading, it's either you're right or wrong. So I don't want to make this too complicated, but at the same time, I do want to add more advantages for us in trading. So when you're right, you profit more. When you're wrong, you lose less. Okay, and that's always the ultimate goal of a trader. Okay, cool. So now that you understand a little better what I'm going for today, let me change page. Okay, and let me start again. Okay, so key components to be kept in mind when buying options. Okay, and again, when I say buying options, means debit strategies. Of course, if you do a vertical spread, you buy an option, you sell an option. Okay, so I'm calling these buying options because you end up with a net debit. It's a net payment. You buy an option that costs you 5, you sell an option and you sell it for 1, so you are a net payer of 4. You paid 5, you receive 1, you are a net payer of 4, that's a debit. I'm calling it buying options, okay, even though it may be a combination. So, key components to be kept in mind when buying options, okay? Well, first, the current level of premium for those options. The current level of premium for those options. When we talked about options, okay, in those sharpening sessions for options, we talked about the fact that there are times where options are undervalued and there are times where options are overvalued. Sometimes it's subtle, sometimes it's massive. humongous. And of course, if you were to buy, let's pretend for a minute that you bought, okay, you bought a very overvalued option. Okay, so let's say a fair price would be 5, okay, but you paid 25. Well, now you have a problem, okay, because you may have the stock move in your favor, okay, you may have the stock move in your favor, but the option goes from undervalued to fair price, and even though the stock is moving in your way, because you bought the option and you pay way too much for the option because it was overvalued, then you lose in the trade, even though you were right in the direction, okay? And that would be a big problem. That would be a very, very big problem. And this is why when we are using our scans, let me show you the customized scans that we use. One of the parameters that we selected here is that for the implied volatility, okay, for the implied volatility, we wanted that IV in a percentage, we want it to be in the bottom 50. In other words, out of all the options in the market, all the stocks in the market that meet all the other criteria of the scan would only return the results where maximum 50 results, where those 50 results would be the lowest priced options in the market. Okay, and why is that good? Because if the option is underpriced, then you paid less. And if you paid less, then remember, the most you can lose when you buy an option is what you pay for the option. So if you happen to pay less, now you have less to lose. So you have less risk. Plus, if the option is undervalued, and then the price of the option goes back to, let's say, fair, no matter if the stock is moving your way or against you, let's say the value of the option is going back to fair instead of undervalued, well then you may be able to exit the trade for less pain than what you would if you purchased the option when the option was fair and the stock went against you. Okay, so the idea is to, I mean, like, it's common sense, it's buy low, sell high, but knowing that the price of the options, okay, have many moving parts, multiple moving components, and one of them have to do with the expectation for future movement. Okay, the level of premium has to do with the expectation for future movement. Okay, and that expectation for future movement, you know, depending on what people are expecting, more people buy or less people buy options, and therefore that directly impact their price. Classical example of that is an option right before earnings. If earnings are going to take place, many people are going to be thinking, oh my God, this company is having very good earnings multiple months in a row. They just launched a new phone. They just launched whatever. You know, I've been reading about the company. I am expecting earnings to be good. Therefore, let's buy options because that stock is likely to jump with a big gap during the earning report. And many people are willing to buy options because of their expectation for future movement, or the opposite of what I just said. Maybe the expectation is very bad. So now what they want to buy is puts instead of buying calls. And because there is that expectation, that creates an excess of demand for either puts or calls. And next thing you know, the price of the option goes up, even though the stock hasn't moved yet. But because many people are willing to buy options, okay, like everything in life, if many people want to buy, you know, some car, some specific model of a car, then, you know, the company that makes that car will sell it for more because there is demand. So it's the same thing in options. If many people are willing to buy the 300 call on the S&P, so then the 300 call of the S&P will gain value even if the S&P doesn't move. Okay, so it's an important concept to be kept in mind. Okay, so now, so the current level of premium is key, and is very, very, very important that you don't buy options just because you like options, and also you like a certain stock, and you identify based on the chart and the UFOs, you identify an opportunity, and you just go ahead and buy options without checking if those options are undervalued. Okay, that would be a big problem. Okay, so the way we are running it in the sessions at the moment, okay, and we'll get more sophisticated in the future as well, as we are doing with everything since we've been working together, guys. But the way we are doing it at the moment, okay, we are just using the scanner. And again, I just showed you a minute ago the settings for the scanner, where we are shooting for options that are in the bottom 50. And this guarantees, in the vast majority of the cases, that you will not be buying options of a high value. Okay, so that's key. Okay, there are two concepts in options trading that are often misunderstood. One is what is known as IV, which stands for implied volatility. Okay, that's one concept. Another concept is Vega, which is one of the Greeks, that tells you how much you will make or lose given a change of IV. Okay, that's why Vega measures. Vega tells you how much you will profit or lose if implied volatility changes. Okay, and many people talk about cheap options or expensive options as options with low Vega or high Vega, and this is absolutely incorrect. An option that is underpriced would have a low implied volatility. Okay, a low implied volatility. It has nothing to do with how much Vega it has. Okay, the Vega component, okay, the how much you will profit or lose given a change in Vega, has to do with things such as, is this option in the money or out of the money? Okay, it has to do with things such as which expiration date I have selected, knowing that the longer the time to expiration, the greater the Vega. Okay, so in other words, if you buy the 300 call that expire in 1 week, that 300 call will have a lesser Vega value compared to the 300 call that expires 6 months from now, because the longer the time to expiration, the greater the Vega. Okay, but the Vega, okay, don't get confused, the Vega doesn't tell you how expensive or cheap the options are. The Vega tells you how much the option will change if the option changes its implied volatility. In other words, if the option was undervalued and it go back to fair, or the option was overvalued and it drops to fair, okay, Vega will tell you how much you make or lose on those movements of having the options prices grow or shrink based on the future expectation for price movement. Okay, but again, don't get confused with implied volatility and Vega. Okay, these are two different things. Okay, it's just like if I tell you time to expiration, okay, and you may say 5 days, and you say theta, okay, and you may say 10 cents. Okay, so what does that mean, 10 cents? Well, 10 cents means that every day that time passes, okay, the option is losing 10 cents of value. That's theta. So theta is a Greek, and because it's a Greek, it measures the impact on an options price. Okay, measures the impact on an options price. So if 1 day of time passes, the option will have 10 cents less of a value. Okay, so now how many days do you have left to expiration? 5. So those are two different variables. It's two different things, even though they are related because both have to do with time. Well, Vega and implied volatility is the same. They are related because they both have to do with the expectation for future movement. Okay, but implied volatility, okay, it's telling you what's happening now to the price of the option now, just like time to expiration will tell you what's happening now to the price of the option now, 5 days before 5 days before expiration, or given the current expectation for future movement today. Okay, where Vega is a Greek that tells you what's going to happen to the price of the option. It's again the impact on the options price, just like theta, but in this case the impact is not because of time passing, the impact on the change of value for the option if the expectation for future movement was to vary. Okay, that's what Vega and implied volatility means. Okay, so don't get confused. I just wanted to add this because it's a classical confusion among everybody who is learning options, including myself. I remember at times getting confused. I mean, everybody gets confused because, you know, IV has a V, Vega has a V, volatility is in there. So it's easy to get confused, but it's not the same. Okay, so I wanted to clarify this very quickly as well because of some emails received, not so long ago. So current level of premium for those options, okay, it's something to be kept in mind. We want to deal with options that are very low price, very undervalued, and we are doing that at this moment in time in the sessions. We are doing that by using the scanner and scanning for that bottom 50. Okay, and that's how we are doing it. Okay. There are many other ways to do it, by the way, but this is good enough. Because the other thing that we need to know about options is that it's okay to be less precise. Okay, and this is one of the great benefits with options. For example, when we buy options, we are not using stops. I mean, could you? Yes, of course you could, but we're not. Because when you buy an option, if you pay 200, what's the most you can lose? 200. So it's like the stop is built in. So now if you have 3 UFOs and one fell, instead of being stopped out, you're still in the trade, and maybe now the second UFO works well, and you end up getting to your target without having been stopped out. So that's a great advantage. So you could afford to be less precise. That first UFO didn't work, okay, but you didn't get out of the trade, okay. You allow yourself to stay in the trade because you knew ahead of time that the most you can lose is 200. So there was no need to be that precise. That's a pretty massive advantage, okay? So now the same thing that happens directionally, which is that it's okay to be less precise. If one UFO fails, you shoot for the next one. The same thing happens for this concept of implied volatility, which has to do with the current level of pricing for that option. Is that option undervalued or overvalued? So scanning the way we are, looking at the bottom 50 options, it's good enough. Can we get more precise? Yes, we can get more precise. Would it be useful? Yeah, of course, it's always useful to be precise. Okay, but also there is a price to pay to be too precise, which is that you end up missing trades. Okay? See you soon, Lisa. Pleasure to have you here. So you end up missing trades. So always, it's always good to shoot for that balance where you're precise enough, but you don't kind of become like, how do I put it? Like too perfectionist when it comes to identifying the value of those options, okay? Because in the end, it would translate in missing many trades. And that would be frustrating, apart from unproductive. And then on top of that, you open the door to getting emotional because now you get upset and all those things that could happen without even realizing it's happening. Okay, so that's why in the sessions, I always try to keep it cool and keep the processes as simple as possible. So we look for that healthy balance where we have the odds in our favor, but it doesn't need to be the perfect trade in the world. It just needs to be an okay trade. That's it. Okay is good enough. Okay. So now I'll repeat myself one last time and I'll go for the second bullet point. What you never want to do when buying options is to just buy options just because you like the trade, you like the stock, and you just go for it without checking those levels of premium, okay? So my recommendation, 100%, is that you don't look at stocks and then you decide to buy options. My recommendation is that the process you should follow is run the scan. The scan is filtering for low price options automatically and only take trades out of the list provided from the scan, okay, which is this list right here. So that way you are in a position where you are not going to be buying options that are overvalued without even thinking about it, just because you like very much the chart setup, and so, and then you end up forcing a trade that you should know. Remember, if you were to buy an option that is overvalued, you could see yourself in a position where the stock is moving in your direction the way you predicted, but you are not profiting from the trade, because while the stock is moving in your way, that overvalued options is dropping its value back to what a fair value for the option would be. So in one hand, you are making money on the move, but it's being erased by the fact that the option is going back to a normal value, because when you purchase it, it was overvalued, okay? So keep that in mind one more time. I repeated myself, I believe, maybe 5 times, and I said the same thing like 5 times from different angles, because this is important stuff, okay? So make sure you keep that in mind forever, okay? So current level of premium for those options has to do with the expectation of future movement. Okay, so let's make sure we use undervalued options only. Okay, big one to keep in mind forever. Second important concept, okay, is picking the right expiration date. Okay, when loading an option chain, let me do it. So loading Option Station Pro. And by the way, feel free to type if you have any question, guys. You are very quiet today, which I understand, but at the same time, it would be nice to know that you are with me. So anytime you have a question, type it, and it'd be cool as well that you could confirm that you are with me up to this point, okay? So I'm loading the option chain of Facebook, for example, here. So just typed Facebook, so it loads. And notice how we have so many expiration dates, okay? We have many, okay? So, you know, if a trader was to use what I would call incorrect common sense, okay, let me show you what would happen. Okay, so let's say that you have a limited understanding of options, okay, and you identify an opportunity with Facebook, and you know you came up with, you know what, out of all the options, I would like to buy the 190. Okay, so you may look at the 190 in this expiration date, September 27, and the price of that option is $2. You may look at the next expiration date, and the price of that option is $2.82. Okay, and you may start doing math. You may start doing math and say, okay, wait a minute. I got 2.82 for an option that expires in 19 days. So this is like 14 cents a day, almost 15 cents per day, where the other option here, 27th of September, was $2, okay? But that one expired in 12 days, which that's 16 cents per day. So you may say, you know what? The 4th of October, even though it's higher value, it's a little cheaper per day. Okay, so maybe October 4th is a good choice. But what about if you do October 11? Look at the 190, and the 190 is 365. So you look at 365, you divide it by the amount of days, which is 26, and this is telling you that is 14 cents, which is even a little better than before. So now you're like, okay, you know what? October 11 is better. What about I check October 18? You look at October 18, now the 190 option is 440. Was I using the 190 or the 200? I just got confused here. Yeah, the 190, right? I was using the 190. Yes, 190. Sorry for that. So let's say you're doing 190, and now October 18, it's 440. So you do 440 divided by 33 days to expiration. That is 13 cents. Hey, this is still cheaper, right? And you keep going, and now let's say you end up with like, okay, so June 18, 2021, 190 option, that's gonna be my peak, okay? Because let's say this is the one that gives you the very, very best cost per day. You're like, that one maybe is 8 cents per day instead of 14. That's the one I'm gonna use, okay? Well, that would be what I call incorrect common sense. Why? Because in one hand it makes sense, but on the other hand it doesn't. And here's why. Here's why. If you buy this option using June 2021, which is 642 days from now, you're gonna have to pay $33.20 per share. As you know, in the US market, every option has built in 100 shares, is regulated, is standardized. Other countries are not the same. So 33.2 times 100 is $3,300. In other words, that's what you would need to pay. And I'm okay with paying this amount of money for a trade, not a problem at all. But with options, what you also need to understand is that the money paid is your risk. So now you have $3,320 of risk in that trade. Where the fact is that your target may be located just $5 or $6 away, which makes this trade a trade where maybe this trade is going to last 5 days. So you are taking a $3,000 of risk for a 5-day trade that, given the move, okay, let's say the market goes like that and makes $5 up. So given that vertical move up, maybe the option will end up paying you, I don't know, $300 of profit. And you are taking a $3,000 risk to make a $300 of profit just because you just kept going expiration date after expiration date to see which option was giving you the lowest cost per day. Okay, so this would be a wrong approach. And even though it could look like common sense, it's incorrect common sense, because it doesn't make sense to take $3,000 of risk to make $300 of profit, if that was the trade. Okay, so that would not be the right way to approach it. Okay, another way to approach it that would be wrong is like, okay, I decided October 4th. Okay, for whatever reason, let's pretend you decided October 4th, and now you're like, okay, I want to do the 190. Okay, and the 190 cost me to a 282. Okay, 282. But you know what? I could go ahead and do the 205, and that would cost me 21. So if I really want to spend $282 in this trade, and the 205 call cost me 21, I could go ahead and buy 13 of the 205 calls, okay? And I would come up in a much better position compared to the 190, okay? So what would happen if you buy 13 of the 205? If you buy 13 of the 205, they have a delta of 3. So you will get 13 times 0.3, which is a delta of 39. Now, how much is the delta you get for the 190? It's 40. So look, you have a better delta for the same price by buying the 190 in this case, okay? But the other thing that you need to understand is that the further away you move from the at the money strike, the more distorted the Greeks will be. And what I mean by distorted is that, I mean, mathematics are mathematics, right? And you know, TradeStation, OptionStation Pro is applying the math absolutely perfectly, and the Greeks that we see is what it is. So they are not distorted because something wrong is happening in my computer, but they are distorted because the further away a price is, the more assumption the Black-Scholes model or any options pricing model you use, the further away from price you are, the more assumptions that model is making, and therefore the Greeks are less aligned with the reality, and therefore, even though it looks like you get more or less the same delta, in the real world you get much less delta than what you would get if you were to use, in this example, the 190. So again, which option to select should not be decided, okay, just based on the prices that you see here. Looking at these like you are purchasing, I don't know, food for home, where you know you went to a supermarket and there was this, I don't know, maybe you wanted to buy, I don't know, chips, for example, or crisps, and you know the price of that article was discounted if you bought 3 at a time or something like that, and then it makes sense. This is not exactly the same thing. Okay, so here we are dealing with, you know, a derivative instrument that the way this instrument is being priced, it's quite complex compared to other things that we deal with in life, and therefore we cannot simply approach it in this very simplistic manner, because in one hand it makes sense, but as I said before, that would be incorrect common sense to approach it this way. Okay, so that's why you know, in the sessions we are running a very specific process where, when it comes to picking expiration date or strikes, okay, which I will need to explain in a minute. So when it comes to picking the expiration date, okay, the first thing that we do is that we need to calculate the TTT, which is the time to target. Okay, we need to calculate that. Okay, and I will not repeat myself on how we do it because we have done lessons on that. But we need to calculate that because if the trade is expected to take 20 days, it's not the same compared to the trade is expected to take 45 days. It's not the same. You will need to use an expiration date that puts you in a good position where your options don't expire ahead of time. Okay, but also, so in other words, you don't pick the expiration date just based on some calculations that you do, with your calculator, looking at the prices on the chain. You will pick the expiration date based on your plan on the chart, thanks to the UFOs and the auto climate and all the process that you run. Okay, that defines your target and that defines your expiration date after you calculated the time to target. Okay, I have a question here from Marcus. I'm new to options and I'm now at sharpening number 4 with the recordings. I love it. So currently I just let me inspire. My question will certainly come later. I get you, my friend. Still feel free. If you have any question, feel free to ask. And again, if I do feel that is diverting too much from today's session, then I will point at the recording, as you said, and I appreciate you to be understanding. But if I can answer quickly for you, I'll be happy to do that as well. Okay, Marcus, no problem. So anyway, so that's what we are. That's the right way to approach it. Okay, now. Remember, key components to be kept in mind when buying options. Another key component, okay, is that in most of the cases, okay, time passing hurts the position, okay, in most cases, okay, in most cases. Again, it's not always. Like, for example, if I go back to the prior page, okay, horizontal spreads, if you build them correctly, they are positive theta. They actually get paid on time passing. The butterflies, they may start as negative theta, they may end up as positive theta, and they get paid from time decay. The diagonal spreads, if you build them properly, they are positive theta. The double diagonals, they are positive theta. So all of those positive theta comments means that these trades make money on time passing. Okay, and it's kind of weird because it's a debit and you're like, wait a minute, how can that be? If I buy an option and time passes, I should get hurt. Okay? How can I make money on time passing if I am a net buyer of options? Well, I will explain that later because today I will explain what is a diagonal spread, which is something I never got to explain in the sessions. And when you see it, how it works and how it's built, you will understand it immediately. And we'll conduct other sessions for other strategies in the future as well. So you will get to understand how it works for everything. Okay, but today you will learn it for diagonal spreads. In any case, in most cases, okay, so time passing hurts the position, or at least the option bought. Okay, remember, if you do spreads, okay, you buy options in spreads. You buy options and sell options at the same time. Correct? So the option you purchased could be one or more than one. That one will always guaranteed be hurt by time passing. The ones that you sell will benefit from time passing, and they may actually offset the amount of pain you get on the ones you bought. And that's how you end up positive theta in some strategies such as diagonal spreads, as you will see later. But in most cases, okay, it would be problematic. So you always need to be thinking, okay, how can I offset this problem? Okay, how can I reduce this problem? That's the question. Okay, and therefore, one technique that we are using all the time when we conduct the sessions, normally on the Thursdays, right, the sharpening long term, one thing that you've seen me do all the time is to pick the next expiration date that is lining up with the next earning report. Okay. Now, only if this is greater than the TTT calculation that we did. So in other words, if the next earning reports is going to happen in 30 days, but the TTT told us that our time to target is going to be 55 days, then I should not take this trade, because I'm going to have earnings be reported before I reach my target. And the earnings report may create an important movement, an important gap against me, which happened before I reach my target. So then you should pass on the trade, right? So if the TTT is, let's say, 45 and the earning date is 55, then you would pick the expiration date being 55, because now not only you have given yourself time enough to get to the target, on top of that, the effect of decay of those options will be somehow reduced, because as the earnings date is approaching, people are going to be very interested to start buying many of the options that are expiring around the earning report date, expecting that gap to happen and profit from that earning play. Okay, and all those people buying those options will reduce the effect, because now, remember, for all those people buying those options because of that earnings report, well, that's because they expect something to happen in the future. In other words, we have a greater expectation for future price movement that will re-increase, or if not re-increase, slow down the decay process of those options as time passes, because many people are purchasing those options because of their expectation of future movement, which have nothing to do with your trade. Okay, but thanks to that, it's helping to not to be hurt as much on the erosion, the normal erosion of, that time passing will affect the value of an option, which is known as time decay. Okay. So we always need to keep that in mind, as you have seen me do all the time. Okay. And finally, when it comes to picking strikes, okay, we need to look for a proper exposure to the directional move that we are trying to catch. So what do I mean by exposure? When I mean exposure, what I mean is delta. Okay, so delta, as you probably remember, is the Greek that tells you how much you profit or lose given a movement in a specific direction. So D for direction, isn't it? So in other words, delta measures how much exposure you have to that direction. So if I was to get into a trade, I'm going back to this option chain. If I was to get into, if I was to get into a trade where I plan to use the 205, okay, well, the 205 will give me an exposure of 3% of the move. So we have a move as expected going from entry to target. So you are right on the trade. But next thing you know, you profit on the move by 3% of what the move has been. Well, I don't know if you agree with me, but to me that's not worth it. You are really not exposed to the move if you only profit by 3% of whatever the move has been. Okay? So what would the rule be? Well, you probably remember from the sessions that our rule is to shoot for a delta of around 30. Okay? So 30, more is okay too, okay? But you will see in a minute why 30. So 30 delta or 0.3 delta, depending if you look at it in the option chain or the simulation. Remember, in the simulation, everything is times 100. So 0.3 delta is ideal, okay? And take a look at why. Okay, so I just made the same mistake again. I don't want to click, I want to right click. So I'm gonna right click and analyze and buy a single option so I can get it here in the simulator. And what I want to simulate here, I don't want to simulate the theoretical value, I want to simulate delta. Okay, I want to simulate delta. That's what I want to simulate. Okay, now again, to do this properly, maybe I will need to remove many lines and push this down to have as good as possible as a scale for this graphic. But basically, if I look at 30, which is here, okay, this is where we're at, okay, this is 30. And so statistically, you know, and if you were to observe many options charts like this, you will notice, and again, I don't have exactly the picture I was looking for because it also depends on the strike of the option you select. But basically, what's happening is that if you were to look at this curve and this angle, okay, it's kind of slow, where this part of the graph starting at 30 has a little bit of a steeper, and I apologize for not being totally precise with my drawing, but it's kind of like this portion of the graph has a stronger angle compared to this portion of the graph. In other words, you have a greater acceleration of delta, okay? You have a greater acceleration of delta in this part of the curve, and you have a flatter changes on delta in that part of the curve. And again, my drawing is quite terrible, which I apologize for that. But what that means for a trader is the following. What that means for a trader is the following. If you're right on the trade, okay, and let's say you are long, okay, so here on the right, I'm just gonna draw the chart, okay? So let's say this is your starting point, okay? Two things may happen. The stock goes against you and falls, okay? Or you're right and the stock goes up in your direction, okay? And this is assuming you are planning on a long trade. So as the stock is going your way, okay, you know there is a magic Greek called gamma that will increase your delta. Okay, it's the dynamic leverage effect of options. We love that. So if you get deltas around 30, okay, given the fact that for you to profit, when you do debit strategies, when you buy options, for you to profit, you need to catch a move. So if you buy options around a delta of 30, it's pretty cool because you are basically finding yourself in the most vertical portion of this graph. And what does that mean? That means that you will gain more and more and more delta. Notice that at the current value, your delta will be 30. But if that stock goes up to 184, now your delta is kind of 40. If the stock goes up to 186, okay, now your delta is 45. So, you know, you have this effect of gaining delta, which is normal no matter which option. But because you bought an option with a delta around 30, there is a lot of increase of delta to be happening, and the speed at which this increase of delta will happen is likely to be quite efficient because your starting point is this kind of like, difficult to see on this graph, but it's kind of this inflection point where below the curve is a little flatter and on the right the curve is a little steeper. Okay? If the stock goes against you, the opposite is true. The more the stock goes against you, okay, the more slowly, okay, you will be losing, okay, and you are getting very close to getting flatter, and therefore that no matter how much the stock keeps going against you, it doesn't hurt you more. Whatever the pain was is whatever it is, and it doesn't matter that it keeps going. There is a moment in time it will not hurt you more, right? And so you are benefiting from this side of the curve. Okay. Now, if you were to buy an option with a delta, like for example 80, okay, so this is like around 80. So what's the problem? Okay, if the stock goes your way, yeah, of course, the delta will still improve, but notice how now it's really, really flat. And by the way, the most it can improve is from 80 to 1. It cannot go above 1. Above 1 is flat, as you can see, right? Well, if the stock was to move against you, okay, the stock drops, okay, well, notice that the delta has a lot to drop as well. So if the stock was to drop and then come back to you and recover, it would take a long move for you to get back to your 80 delta and get back into business. Okay, so it's again, and this is putting on the side the fact that the 80 delta option it's going to be way more expensive. It's going to cost you 13. Okay, the 80 is going to cost you 13, where, you know, if you were to do the 30, it would only cost you 192. Okay, so it's way cheaper. Okay, so that ideal strike, it's around 30 because of those reasons. And again, there is much more thought behind all of this. Okay, but hopefully this clarifies an important question. Okay, question from Marcus. Expiration date around earnings, does it mean close to an expiration date before or at earnings, or also after earnings date? How many days plus or minus? It's difficult to answer, Marcus, because sometimes, you know, with when options are being released, okay, the way the expiration dates are being released, okay, we call those options listed options because they are listed by the exchanges. So how exchanges list options depend on liquidity, on market makers. There is regulation and rules. Okay, so there's, you know, there are options that need to be, like, for example, you need at least 3 monthly options separated by 3 months each. You know, so there is requirements based on the regulation on how many options are or should exist. But look, if you look at a stock that is less liquid, okay, this one, for example, okay, you are likely to have less options. Okay, they still meet the rule, but you have less options. If you were to look at one of the most liquid options in the world, which is S&P, the S&P ETF, okay, notice when it loads, look at how many options are available, how many expiration dates. So what happens is that sometimes you have earnings report on a specific date and you have an option that is lining up perfectly. For example, October 18. Okay, but there are other times, okay, where it's not possible. Okay, so I'm gonna go back to this one. Okay, and maybe your earnings is on, I don't know, November 11, and guess what? October and December are both far. So which one would you pick? You would pick December. Why? Because if you pick the option that expired prior to the earnings, then you don't get the benefit I described before. Okay, you want to benefit from that increase in value of the options because many people are buying them for earnings. So if the earnings are in November, you cannot use October. Okay, but sometimes you will need to pick a date that is quite far from earnings, just because you may be dealing with a stock that got less liquidity and therefore less expiration dates listed by the exchanges. Okay? Okay, guys. So look, I'm looking at the clock. Okay, and normally at this time I would do a break, but if that's okay, I will not do it. Okay, because I think that we'll be done in 20 minutes or so. So I'll just keep going, and we'll finalize the session at that time if that's okay. Okay? Yeah, no worries, Marcus. Very good question, by the way. So proper exposure to the directional move we are trying to catch. This means delta is 30. Now that delta, okay, needs to be the net delta. Okay, and the net delta means the net result of adding all the deltas of all the options that you use if you were to use a complex combination, such as a spread, which uses 2 options at a time, or a butterfly that uses 3 options at a time, or something even more complex that could be used 4 or 6 options at a time, right? So whatever options you use, when you add up all the deltas of all the options, you will want at least 30 delta as a net delta. And by the way, net delta also means positive delta if the trade is bullish, negative delta if the trade is bearish. Okay, so knowing all of this, now that we understand all of this, which is a little bit, you know, I talked about this in prior sessions, but I believe this is a more thorough, in-depth explanation. So hopefully it helped to clarify maybe some missing parts. Now, what I would like to do is I would like to explain it when applying it to vertical spreads. Okay, and then I will get you introduced to the diagonal spreads, okay, and how they work and all of this, okay? So that way, you know, I also now open the door for myself So when we run the get together sessions, okay, I will not only be using verticals, but also I'll be adding diagonals into the mix, okay? And every time trying to enrich the session more as we are sharpening skill together, okay? And time is passing. In our case, it's not time decay. In our case, it's skill building, okay? Geneva, very good. Very good, no worries. So vertical spreads. So a vertical spread, as you probably remember, and you know what, I'm gonna insert a little table here just to make it a little more organized. So a vertical spread, okay, you have two versions. You have the call spread, okay, and you have the put spread, okay. The call spread, okay, it's bullish, so we call it a bull call spread, okay. It's bullish because it's a debit, okay. So when you pay for the calls, that's bullish, okay. And the put spread, okay, the put spread is also a debit, okay, and therefore it's bearish. Why is it bearish? Because when you buy the puts, that's bearish. Okay, so again, this is nothing new. You guys know this. Okay, so now how do you build a vertical spread? Well, the first thing is to select. Okay, the first thing is to select your target and sell calls beyond. Okay, beyond the target. So notice that when dealing with options, targets are very critical because thanks to the target, you calculate the time to target, and this sets the expiration date. Okay, but also for you to decide which call to sell, you also need the target. Okay, so in other words, to do vertical spreads, you need a target. Okay, if you were not able to find a target, for example, stock making all times high, right? So then you could not, or more than could, you should not build a spread, okay? At that time, this is when you buy an option, okay? Buy an option by itself, okay? Calls when you are bullish, puts when you're bearish. Just buy the call or just buy the put. That's it, okay? Because you would be trailing stop, and that's how you would end up maximizing your profit. And how do you deal with the time to targets if there is no target? Well, you just use the expiration date that lines up with the earnings report date, because you cannot calculate time to target because there is no target, okay? So again, a little comment here. We had that case the other day, by the way, right? I think it was, what was the trade? Lulu, right? So we are in a trade with Lulu, I believe. That is exactly like that, okay? It was making all times high, if I am not mistaken. So back to building the bull call spread, okay? So we are building a bull call spread, okay? And how do we do that? We sell calls beyond the target, and then we buy calls, okay, between the target and the current price. Okay, and between means where exactly. Okay, so that's when delta comes into play, and we adjust to get our delta. Okay, and you have seen me do that in the sessions. Okay, so hopefully this is clear. Okay, so now with the bear put spread is exactly the same story. You would start, okay, you would start with selling not calls but puts. You would sell puts beyond the target. Now when you are bullish, okay, the target is above. When you are bearish, the target is below, correct? So therefore I need to put my line in the bottom part of my table, where in the case of the bull call spread, my line is above, okay? Example, just to use numbers as an example. So maybe you sell the 100 call and you bought the 90 call, Okay, so 90 is below 100, 100 is above 90. So vertically speaking, that's why it's called vertical spreads. Vertically speaking, you buy the 90 call, you sell the 100 call. Okay, why the 100 is above? Because above is the target. Okay, and 100 has to be beyond, meaning that maybe the target was 99. Okay, so you sold the 100. When selling puts, okay, is the opposite. Okay, when selling puts is the opposite. So maybe your target was 81, so you sold the 80 put. Why 80? Because 80 is beyond 81 on the way down, because the bear put spread is a bearish strategy. Okay? Now, just like we were buying calls between the target and the current price, so we are going to buy puts between the target and the current price, shooting for the delta to be 30. So which puts this would be? I don't know. We can look at that in a chart, but in this example, let's make it up. And let's say, for example, 95. So you would buy the 95 put and you would sell the 80 put together at the same time. If this was to give you 30 delta, then that would be the net delta for the trade. That would be 30, which is what we say is ideal, and you would be good to go. Let's say you try the 95. Okay, and this is going to be a little bit of a quiz, guys. So if you are listening, pay attention, because I'm going to ask you for answers. So question. Okay, let's begin with the calls. So let's say I buy the 90 call and I sell the 100 call. Okay, and my delta, instead of 30, my delta is 40. Okay? Remember, I'm looking for 30 delta. 40 is too much. Okay? 40 is too much. So question, what should I do? What should I do? Should I lower the 100 call to be maybe 95? Okay? Should I do that? Or should I take the 90 call and maybe make the 90 call to be 92? What should I do? Rise the call I bought or lower the call I sold? What should I do? What would you guys say? Okay, so the answer is either rise or lower, and this applies to either the call you buy or the call you sell. Okay, you can make the call you buy to be 89, or leave it as 90, or make it 91, and you can make the 100 call you sold, you can make it 99, or leave it at 100, or make it 101. So you can either rise or lower the call you purchased or the call you sold. So which one is the right answer? Okay, so I would expect you to type in the chat box using those words, rise or lower, and then it's either the call you bought or the call you sold. Yeah, sell beyond the target remains the same. You're correct. So that means that we will be dealing with the call we buy, isn't it? Okay, and I can see some of you took a little break. Or maybe you're thinking, okay? Yeah, so what you would do is that you would rise the one you purchased, 91, 92, 93, 94. Remember, if you rise it, you make it cheaper. If you make it cheaper, it's less delta. And therefore, the net would go from 40 to 38 to 35 to finally find the closest we can to 30. Okay, and that's what we call adjustments. Okay, so you would do an adjustment. Okay, this one, sell the calls beyond the target. That one will be fixed. Okay, sometimes we change it. Okay, okay, but almost always fixed. Okay, like almost always fixed. and then you would just work on the one you purchased, okay, adjusting it to have an overall delta of 30. That's how you would do it, okay? With the put side, is the same, okay? So be ready, guys, because here is a quiz. Okay, be ready. This is a quiz, guys. So let's say you are buying the 95 put and selling the 80 put, okay, and your delta is 40, and you want to reduce the delta. So what would you do? Would you rise the 95 put to 96, or would you lower it to 94, or would you leave it the same? And then what would you do with the 80 put? Would you make it 81? Would you leave it the same as 80, or would you drop it to 79? Okay, so again, the answer to this question uses the word rise or lower. And you also need to tell me which is the put you buy or the put you sell. Okay, so Parvez, good to see you, my friend. You lower. I'm not sure. Hey everybody, if you hear me, it would be nice if you could confirm that you hear me. Quick message would do. Oh, perfect. Yes. Okay. So yeah, so I'm having a double problem, but just fixing it now. 1 sec, and we'll restart. I just yes. Okay. So yeah, so I'm having a double problem, but yeah. 1 second, guys. Almost there. Okay, I think that everything is back to normal on my end, and we'll be able to conclude the session normally, guys. Sorry for that. I'm not sure what happened, but it's good to have a backup internet just in case. So anyway, let's continue. So we were talking about rising or lowering strikes and all those things. and the answer was to lower the strike. Okay, so if you were to go from 95 to 94 or 94 to 93, that would make the put cheaper, and if the put is cheaper, you have less delta. Okay, so that would bring the delta down to 30. Again, those are things that when you do for the first time in your life, you are always thinking about it, and was it raising or was it lowering or whatever. But then when you start planning your options trades and you do it a few times, it's really a piece of cake. Okay, and it becomes second nature very, very easily. And that's it. Okay, but anyway, so now that we kind of reviewed some of the things that we knew already about the vertical spreads, okay, I would like to introduce you to the diagonal spreads. Okay, and really the difference is very simple. With the vertical spreads, we use same expiration date for both options. Okay, the one you buy and the one you sell, same expiration date. Okay, same expiration date. Okay, the one you buy and the one you sell. So in this table I've been talking about delta, but if that's okay, I'm gonna add theta into the equation. And think about it. If I buy the 90 call, this one will provide some negative theta. Okay, and probably because that one is closer to where the price of the stock is currently, is gonna be, let's call it 2 negative signs of theta, where the one I'm selling, which is beyond my target, okay, that one, because it's further away, that one will have less theta attached, because since that option is further away, then it costs less, and because it costs less, then there is less to decay, and because there is less to decay but it's the same expiration date, then the theta of the 100 will always be less than the theta of the 90. And the same thing happens with the puts. The puts I sell where my target is will have little theta, where the puts I sell where my closer to my entry is will have a greater theta. Okay, and theta is always negative. Okay, but wait a minute, theta is always negative. Okay, and therefore if I buy negative, then it's negative. If I buy something negative, I get something negative. But when I sell something negative, it becomes positive. Okay, so you will have one positive sign of theta and 2 negative signs of theta. Same happens with the puts. If I sell the negative, it becomes positive. So what is the end result of this? Well, the end result is that my the net theta, okay, would be slightly negative. Okay, because you have two negative signs plus one positive sign. One of the positive signs get rid of one of the negative signs, and therefore you are left with one negative sign net. And Marcus, I'm reading your question about what's the goal of doing spreads, and to be honest, I could talk about it for 2 hours, okay? But I will keep it very short. Goal number 1, reduce theta. Theta is always a pain. So now you just reduced it. Now you lose less per day just because time passes. Okay. Another reason to do spreads is to reduce risk. Okay. If you buy this call and that call cost you 5, let's say 500, but instead of buying the call by itself, you were to buy the call and sell the call, and that one is gonna pay you 200. So you pay 500, get paid 200. Your net cost is 300. And if your net cost is 300, what's the most you can lose? 300. Where if you didn't do the spread and you only bought the call, and that would cost you 500, so what's the most you can lose? 500. So you reduce the risk with the spreads as well as you reduce the theta. Okay, and this is gonna be my short answer to you, even though I can talk about it for 2 hours. Okay, spreads are amazing. So now, what if you were to do the same thing? Let me copy this. What if you were to do the same thing okay? But now, instead of vertical, we call it diagonal. So what's a diagonal spread? Okay, so what's a diagonal spread? It's the same thing. It's all exactly the same, but one thing. So the one thing that changes is that we're going to use different expiration dates for the options. Okay, different expiration date for each option. That's the difference. Okay, so what's the impact? Well, the option I buy is going to be the same, using the same TTT, using the same expiration date and everything. So you will suffer 2 negative signs of theta. But what about the 100? Okay, I'm going to use a shorter expiration date with the 100. Okay, shorter expiration date for the one that is close to the target. Okay, so it's going to be a shorter expiration date. Let me just copy this in the put side as well. Okay, so now if the expiration date is shorter, and you may remember this from our Greek lesson, so remember, all options got negative theta, right? And the shorter the expiration date, the greater the theta. You may remember this from our lesson on Greeks. If not, I'm just reminding it to you. So let's say, out of simplicity, that this option will have 3 negative signs of theta instead of 1. Why? Because it's a shorter expiration date, and the shorter the expiration date, the greater the theta. But remember, when you sell the negative, then it's positive. In other words, it's 3 positives sign of theta, not 1, but 3. You go from 1 to 3. So what's going to happen to the net theta? It becomes positive. In other words, you did the spread, you reduced the cost of the trade, but now, instead of suffering time decay, you actually profit from time passing. You will not make a fortune, but it's a nice to have that instead of suffering time decay, you turn it around and now you are making some minor profit on time passing. That's what is called a diagonal spread. Now I know the question you're going to ask me, so before you ask me, I'm going to answer, and then we'll conclude the session. So the question is, if the diagonal spreads are so cool this way, why would you ever do a vertical spread? Right? Well, the answer is because the diagonal spread, because of the same explanation I just gave you for theta, the diagonal spreads are going to be heavily loaded on Vega, where the horizontal spreads are close to no Vega exposure. There is some Vega exposure, but it's minor. Okay, so let's call it minor. Okay, so close to no Vega exposure is minor Vega exposure. The diagonal spreads are heavily loaded on Vega. So if you didn't buy an option that was really underpriced, what could happen is that you may find yourself in a position similar to you have bought an option that is overpriced, which we discussed at the beginning of the session, which is that, you know, the stock is moving your way, but instead of making a profit, you are actually taking a loss. Okay, so we'll need to add a little more precision on understanding volatility, which we will little by little, and doing diagonal spreads will be a little more sensitive and will require a little bit of more precision to make sure that we don't get hurt on volatility changes, okay? But this is a very nice strategy where you turn around the problem of time decay, you turn it into a benefit instead of an inconvenience, okay? Anyway, guys, I'm a little unsure that my internet connection is holding well, so I would like to confirm two things with you. First of all, how are you doing? How was the session today? Is there any pending question? If that's the case, this is your time. And the second is, do you hear me? Is the sound correct? So I know that we are fine to either take your questions or conclude the session. So please give me some feedback, and then I will know. We always have a little delay with YouTube and so on, and with my internet issue, I'm expecting the delay to be a little more. So I'm just waiting. But again, please go ahead and give me, even if you don't have any question, it would be good to know. Thank you so much, Marcus. So I can see now that sound is correct. Okay, good. So guys, sorry for this end of the session with a little bit of tech issue. But in any case, I believe that today we have done one more step, getting deeper into the world of options. And of course, we'll continue. You heard me say many times, options give you options, and it's true. And therefore, there are many things to be explored and to be discovered. So wonderful, guys. Okay, thanks for your comments. Very nice of you guys. You guys are always so kind to me with your words. So it's very nice. Dehide, and if you want access to the notes as well, just shoot an email, okay? We'll be more than happy to send you a copy of this Word document. Just keep in mind, as I said a few times, that the way I'm typing these documents is in a way that is quite informal, because I believe, I'm a believer that it's quite useful to do it this way for educational purposes, but at the same time, it's not like this document is very good too good looking, okay? So we'll be happy to send it to you, but please don't be too critical when it comes to how it looks, okay? Anyway, you guys take care. A pleasure to join you today for like an hour and a half. We will see you during the weekdays in the trading sessions, okay? And also with Brian with the vitamin T sessions, okay? You guys take care and see you soon. Bye-bye, everyone.